And what a week, you guys. It's time for the last mortgage rate update of the week. And last week was crazy. This week was crazier. I'm going to show you what happened this week. I've seen more volatility in a day than I normally see in a full year. But today ended well. So we're just going to jump straight into it today. You guys don't need all the nonsense. But I will say this before we go. Remember, interest rates are a means to an end. Whatever you get today, if it goes up higher than what you have today, you're very happy you have what you have. If it goes lower, you refinance. Always keep that in mind. Okay, don't panic. Stay focused on the bigger picture of owning your home and growing wealth over time through real estate. That's the bigger picture. Now I promise we'll jump in. Okay, here we go, you guys. Here's today, and we love green lines. So what I want to first point out is, look at this. 102.73, 104.9. That means we had 225 basis points basically of movement today. Oh, that seems aggressive. Yesterday was 300, but look where yesterday settled. It got better, it got worse, and then through the end of the day, it recovered to this middle ground, which obviously, I love my little lines, and some people will like to say that this doesn't mean anything, but I just think there's no way it can't mean something, that these things all end at the same point. 1, 2, 3, 4 touches all in that same area. So here's the long and short of it. Today was a very good day. Here's what I want you to understand about today, by the way. When they're investing into mortgage-backed securities and treasuries, it's an investment. They're investing in those things. That is not debt. They're making money on their money. They're stimulating the economy in a big way by doing that, because it's going to keep all of us buying houses because the interest rates stay low. Now, they started doing that Monday, but why didn't it work all week? What you have to understand is, with the volatility in the stock market, hedge funds, for example, are going to have margin calls, right? Stocks are tanking, there's margin calls. One of the quickest ways to get cash is going to be from mortgage-backed securities. So they're selling those assets and paying off their margin calls. So by doing that, even though the Fed's pumping money in, there's still money coming out, right? Something's got to stop the bleeding. It's like giving somebody a blood transfusion when their femoral artery is still bleeding. It's just going to go right through. It doesn't matter. So we need the stock market to mellow out. This is my personal opinion. This is just my own logic I built today. Well, this is always all my opinion, obviously, just so you guys know. But here's what I'm thinking. When the stock market settles down, the margin calls subside, the panic mellows, we are going to feel the benefit of the Fed putting money into mortgage bonds and to the Treasury. We need that to happen before we truly feel the benefit. $1 trillion is a ton of money. So when that happens, and it will, we're gonna start to feel the benefit of it. So even though today, great to see that giant green line, meaning rates got way better today than where they started off today, we're not truly feeling the full benefit. Interest rates are not as low as they should be. Well, I'll show you. Hold on. Let me show you one more thing. Okay, so you see this line here? So this is kind of my old school thought process. Okay, rates should be basically the same as they were on around February 28th, right? And they should be better. Rates should be better than they were on February 21st, because we ended at a better place than we did on those days. So rates are better, right? It doesn't work that way right now. There's just too many variables, too many factors. And that's why I'm looking at pricing every single day, every minute of the day. It's unreal, actually, how much we have to pay attention to this. So bottom line, long story short, I'm going to keep this one short. We ended in a really good place today. We've seen more volatility in the last 2 weeks, basically, the last 9 days than we've seen ever. 300 basis point swings. Yesterday was the first time I've ever seen that, and I've been doing this 19 years. It's just crazy. So keep calm, right? We understand, as long as we understand what's going on, we can be prepared for it. So understand that the stock, usually what happens is the stock market sells off. When that sells off, people move money to more secure assets like mortgage-backed securities, and we see rates go down. But right now, the stock market sells off dramatically. There's a margin call. I need cash right now to pay off that margin call. I better sell some mortgage-backed securities. So they're both going down. And that's what needs to end. When that ends, we will all start to feel the benefit of what the Fed is doing. the amount of things that really the government and the Federal Reserve have put into place in the last week has been awesome. Like, it's really going to make a big difference for a lot of people's lives. There's a lot to come from this. Again, stay home. I know the virus, some people say it's not very serious. I don't think it's serious for me or for my family, my kids. It is serious for my grandfather. So I'm staying home to avoid carrying something that I may or may not have. So if we all do our part and stay home, the sooner this thing mellows out and goes away, the sooner the markets recover. If for no other reason, stay home to save people's jobs. Let's just start there. So if you guys have questions, of course, call me, email me, text me, contact info right here. Leave comments right below. I love having conversations about this stuff. And if you're looking for a new strategy to still buy your house during this incoming recession we have, click this video right here and you can see my recession-proof mortgage plan. Talk to you guys soon. Have a wonderful weekend. Talk to you Monday. Bye-bye.